Welcome back to FT Markets. The waves have been crashing in foreign exchange markets over the past few weeks and months. We've seen some quite dramatic moves, not just in euro-dollar rates, but also in currencies such as the Russian ruble and the Swiss franc. With me to discuss what's behind all these moves is Simon Derrick, who's the Chief Currency Strategist at BNY Mellon. Simon, welcome to the FT. If you look at some of the moves we've seen recently in a historical perspective, you have to really go back to the 1980s. Just tell us what's going on in foreign exchange markets at the moment.
Well, we can look at some fairly simple things first. We can talk about policy divergence between the US and Europe.
You can see in our first chart, just on the euro-dollar, this is year-on-year changes recently, and in fact the year-on-year change this year, euro-dollar, biggest since, well, before you and I were writing about foreign.
Definitely.
Back to the 80s.
Yeah, but you're right. It is very much like the 80s in the sense we have at least until recently had what seemed like a fairly hawkish Fed that stood in sharp contrast to what we saw in Europe, and we saw currencies that were moving far more freely. And it does feel in a lot of ways like the early 1980s. So that's one simple explanation that simply Europe's going one way with policy.
Yeah, we have a huge transatlantic divergence in interest rates. But it goes broader than that, doesn't it? If we look at our second chart, you can actually see we've had really quite extraordinary moves in the past 12 months in Swiss franc, when the Swiss National Bank gave up trying to keep its currency down, and also in the ruble, which maybe suggests there's something more to what's going on.
I think you're absolutely right. I think one of the really interesting things to me is that over the course of the last 6 months, we've suddenly started to see some really quite extraordinary foreign exchange moves develop in a whole range of currencies. And his question is, what is it that's driving that? Now, is it more than just interest rate differentials?
You have a theory about what's going on. Tell us what your theory is.
Yeah, I mean, I think that it's really noticeable to me that these moves have occurred since we've really gone wholeheartedly for negative deposit rates in Western Europe, in continental Western Europe. ECB, Swiss National Bank, the Danish National Bank, all have got these serious negative deposit rates.
Yeah, you look at the flows. What impact is that having on investors then? I mean, thus the exchange rate?
Well, I think that what we've seen, first of all, obviously we are seeing significant outflows from currencies like the Swiss franc and the Danish krone, no question. I think what it's doing, though, is driving investors that previously would have preferred to keep in relatively safe assets to start to look for far riskier assets. Now, in times past, maybe they would have gone for money market funds, maybe they would have gone for sovereign debt in Northern Europe. But with the yields there negligible or even negative, they're being forced further out along the risk curve. I think because of that, what it means is that any time anything adverse comes along that may dent their confidence, they're far quicker to move towards a defensive position than maybe they otherwise would have been.
If you look at our final chart, it just shows euro-dollar movements. Just last week, we had the Fed meeting on the Wednesday. The dollar had, of course, been rising steadily, but then suddenly we saw the euro soaring back up again, and quite big swings throughout the week, which backs up to your point. Then.
I mean, I think that is almost a perfect example of this. No question that what the Fed told us last week was hugely significant. Now, I would not downplay Yellen's comments about the dollar at all. Nevertheless, we had a 4% move up in the euro, followed by a 4% move down in the space of 24 hours, only to be followed by a subsequent rally in the euro. That says to me that we have a market that's far more volatile than it normally would be, which suggests a market where people are naturally being forced to be longer risk or shorter volatility, however you want to name it, and people are reacting very, very rapidly to relatively straightforward events.
What does this mean, very briefly, as we head towards possible Fed increase in the next few months or so?
Well, I think that if we're looking out further, I still think the dollar will start to appreciate, but I think that we're going to have a lot more of these events as we continue to see uncertainty. Absolutely.
Simon, thank you very much. So, spikes in volatility ahead as the Fed moves towards raising interest rates, but the powerful impact of QE by the European Central Bank behind it as well.